Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? It's Wednesday. Yeah, Wednesday, August 21st, 2024. Hope you are having a fantastical day out there in the interwebs. Let me just make sure it is Wednesday. Yep, Astros are playing a day game. Yep, so it's a Wednesday. Yeah, and they're losing right now, 3-1 in the 7th or 8th, somewhere around there in playing Boston. So, and they did not manage to win last night, which is upsetting too. So, hope you're having a better day. It is kind of overcast here in central Colorado, right up against the range, but I'm not going to complain. I've been outside quite a bit this I guess it's afternoon, smoking a chicken. It is going to be delicious tonight. So if you want to come on by, there might be a leg or a wing left over. So, all right. Well, if it is your first time watching the Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. Let's hop into the markets, see how they did today. It was the Fed minutes came out, and it looked like the market reacted pretty positively. Dow Jones was up 0.13%, 54 points, closed at 4890. S&P 500 up 0.4, 22 points, closed at 5619. Nasdaq up 0.57%, 102 points, closed at 17918. The VIX was up 2.33%. It's at 1625. Canada up 0.37. Brazil up 0.32. And Mexico down 0.25%. Jumping over to Europe, Germany was up 0.51. The UK up 0.12. France up 0.52. Netherlands up 0.51. Spain up 0.24. Italy up 0.72. Switzerland down 0.12. And Portugal down 0.06. Russian exchanges split today. The MOEX up 0.14, RTSI down 0.94. And the Asian markets, the Nikkei was down 0.35%. Australia up 0.16. New Zealand down 0.5%. In China, the Shanghai was down 0.35. Shenzhen Component down 0.28. China A50 down 0.17. DJ Shanghai down 0.41. Hang Seng down 0.69. Kind of a thread here across the Asian markets. And the Taiwan weighted when it closed on the 20th was up 0.09. All right. Well, it's the bottom of the 7th. We got man on base, and Dubon is up. Let's see if he could hit a 2-run home run and tie this game up. That'd be amazing. Let's see if I called it. Nope, not yet. All righty. Let's jump into the market recap and see what happened today. U.S. stocks shrug off weaker labor market data as Fed signals September rate cut is in play. So, for all you people out there who've been bitching and moaning wanting a rate cut, you might be getting your wish. Unfortunately, you might be getting your wish as the markets are and the economy is starting to tank. So I don't know if that's really going to be that great because you might be able to borrow money, but how are you going to pay it back? All right, on Wednesday, U.S. stocks rose as investors shook off economic concerns following weaker labor market data. The minutes from the Federal Reserve's July meeting provided a strong indication that a rate cut could be on the horizon, with a, quote, vast majority of, end quote, Fed members suggesting that a cut might be appropriate in September if inflation continues to progress as expected. Just remember, we have more CPI, PPI, all the inflation data is going to come out between now and the September 17th and 18th meeting, probably. So a lot can change between now and then. All right, dude, we got a single. Got the runners on first and second. No outs. Additionally, the Bureau of Labor Statistics revealed that the U.S. Employment gains from March of 2024 were significantly overestimated, with a downward revision of 818,000 jobs, leading to further market speculation about the Fed's next moves. If I could stop here, it is kind of disconcerting. It was the same problem last fall. We'd have these on the headline numbers, everything looked good. It would come out, hey, woo, numbers look great. And then, the revision comes out 2 or 3 months later, and they're like, oh, wait, we actually lost jobs. We didn't gain jobs. But no one remembers that. Who's going back through and reading through reports to see what the revisions were 6 months ago? Very few people. All righty. Goldman Sachs predicted that the total overstatement of job creation between April of 23 and March of 24 could range from 600,000 to 1 million jobs, although they noted this might exaggerate the perceived slowdown in payroll growth. In the corporate sector, Target Corporation saw its stock rise by 12% after it raised its annual profit forecast and reported better than expected second quarter sales, driven by strong demand for low-priced groceries and essentials. Conversely, Macy's stock dropped 11% due to disappointing quarterly revenue, reflecting weaker consumer spending on non-essential goods. God, I can't remember the last time I was in a Macy's. They had one at the mall I grew up nearby, and I think it's still there. Maybe not. I don't know. I don't go to, I mean, there's a mall here. There's like an outlet mall in the little town that we do our shopping in, Castle Rock. But then there's like a mall over near my office. And I think I've walked through it twice in the 8 years I've been here. So anyways, all right. Other notable market movements included a 12% jump in Keysight Technologies stock following its earnings beat, while Lazy Boy's stock fell nearly 4% due to weak future guidance despite strong earnings. JD.com stock declined over 5% after reports that Walmart's plans to sell its stake in the company. Ford Motor Company saw a modest gain of over 1% after announcing the cancellation of its planned 3-row electric SUV and delays in rolling out their new F-150 due to softer demand. Yeah, that was an expensive experiment by Ford trying to go all in on the whole electric car, electric truck, especially the electric truck. That's just stupid. I mean, because most people use maybe not most, maybe half. Half the people who use trucks use them for truck stuff, like pulling, hauling crap. I mean, that's why I've always had a truck, because I hate getting my car dirty. So it's much easier to, just hose out the back of a truck. And, if you're hauling dirt or cement or lumber or whatever. And I mean, I don't never care if I scratch it up on the inside of the bed. So anyways. All right, let's get over to the next bit of news. This has been in the headlines for a few days now. It has to do with the data breach with the Social Security numbers. This comes from Time Magazine. How to check if your information was compromised in the Social Security number breach. So let's see what's going on here. And who's the author? Rebecca Schneid. All right. In April, a major data breach of the National Public Data and a background check service potentially exposed billions of personal records, including sensitive information such as Social Security number, names, email addresses, phone numbers, and mailing addresses. Ooh, that's all super secret. The breach came to light when a class action lawsuit was filed on August 1st in U.S. District Court in Florida, drawing widespread attention. The hacking group responsible, identified as U.S. DOD, has been attempting to sell what they claim are billions of national public database records since April. However, security researchers have suggested that the group may be exaggerating to the extent of the breach. NPD has not disclosed the exact number of people affected, but it's working with law enforcement to assess the situation. The company has advised the public to take precautionary measures such as freezing their credit and setting up fraud alerts with major credit bureaus. As many of you know, I worked in the credit and collections field for nearly a decade post my naval service and before I started doing this. And I don't know. I wouldn't worry too much about this. Personally, I mean, when you're in the military, you stencil your last four of your, well, they did when I've served. The last four of your social was in like all your T-shirts, your hats. It was how you identified, especially for the last name Smith. I mean, there's not a lot of Dahlmans in the military, but there were a lot of people with common last names. So that's how you would tell, whose laundry was whose when, especially on the boat and stuff like that. So anyways, I'm not very worried personally about, identity theft because I know I didn't sign the contract, so I'm not legally responsible for it. The bank has to eat that, unfortunately. They may try to say, hey, well, you owe this, blah, blah, blah. Sorry, I didn't, it's fraud. Nothing you can do. You can't force me to pay it. So, if there's any banks out there that start giving you a hard time, just let them know that you're aware of the Fair Debt Collection Practices Act and, they're have no reason to go after you. All right, let's jump back in here. Let's see. Oh, also, the cynical part of me says, well, is this a thing so that, all these data protection services can make a few extra bucks? I don't know. I can't prove it. It's just, like I said, I'm a bit cynical at times. David Brumley, a cybersecurity expert and professor at Carnegie Mellon University, so he's got to be smart if he works at a college, emphasized that such breaches are becoming more common due to centralization of data. He calls for higher security standards for data custodians and advises individuals to take proactive steps to protect their information. To check if information was compromised, cybersecurity firm Pentester has created a tool to allow people to search the leaked records by entering their name, state, and year of birth. If affected, individuals are advised to freeze their credit files and set up two-factor authentication on online accounts to prevent identity theft. Brumley also stressed the importance of vigilance, including regularly checking credit scores and being aware of phishing scams, as these breaches create opportunities for scammers. Ultimately, Brumley notes that with such a large-scale breach, constant vigilance is crucial in safeguarding personal information. So, again, don't post your be careful. Those like things on like Facebook and places like that. They're like, hey, tell me about the first street, the street you lived on and your first dog and your cat and all. They're trying to get, what you would use as passwords and, or like, what was your mother's maiden name? Or, seriously, that's what, we use in the credit and in the credit world to identify it by your social, your mother's maiden name. Oftentimes you can just set up a password these days. It's not required to, use your mother's name. So, all righty. Last up, the Fed minutes. I know you're excited. This is the best part of every post-Fed meeting is going through the Fed minutes. So we're going to go through this. It's going to take a little while. So if you want to bookmark this and save it for later when you have trouble falling asleep, I will not be upset. All right. So let me bring up my notes here. All righty. So the Federal Open Market Committee meeting, which was from July 30th to 31st of this year. So let's get into it. The first section, developments in financial markets and open market operations. In the recent financial markets review, the Federal Reserve observed that financial conditions had eased slightly during the lower long-term interest rates and higher equity prices, with no significant impact on economic growth. That's, I don't know. Treasury yields declined, especially for shorter-term bonds, leading to a steeper yield curve, which is never good. Let's see here. Market expectations showed a potential. Oh, is it inverted? Hang on. Let me check here real quick. Yep, still inverted. Oh, technically flat. All right, let's get back to it. I didn't want to speak out of turn. Market expectations showed a potential for first interest rate cut at the September FOMC meeting, with further cuts anticipated later in the year. In equity markets, the anticipation of lower rates boosted stocks of small and medium-sized companies, while larger companies, particularly in the tech sector, underperformed. Second quarter earnings reports were slightly better than expected, though some companies noted weaker consumer spending. Globally, expectations for policy rates in advanced foreign economies, AFEs, also declined, reflecting ongoing progress in controlling inflation. Most AFE central banks had either cut rates or were expected to do so soon. The Bank of Japan was the exception, with market participants still expecting it to tighten its policy this year. A French election announcement caused brief market volatility, but its effects on U.S. Treasury markets were short-lived. The effective funds rate remained steady, but repo rates edged higher due to increased demand for financing treasury securities and the effects of balance sheet normalization. Usage of the overnight reverse repo, the on-RRP facility, slightly decreased, with projections of further declines as Treasury bill issuance increases. The Federal Reserve Bank of New York proposed technical adjustments to the secured overnight financing rate, the SOFR production, which were under consideration. The committee unanimously, they all agreed to ratify the DES transactions during the period, with no foreign currency interventions taking place. All right, bases loaded. Jordan's at the plate, 2 outs. We need some runs, fellas. All righty. Staff review. In the July meeting of the Federal Reserve, staff reviewed the U.S. economic situation, noting solid economic activity, but at a slower pace compared to the latter half of 23. Labor market conditions continued to ease, with job gains moderating and the unemployment rate rising to 4.1%, although it remained relatively low. Consumer price inflation, as measured by the PCE price index, remained somewhat elevated at 2.5% in June, with core inflation at 2.6%. The second quarter of 24 saw real GDP growth that was solid but slower than the previous year's average. Net exports continued to subtract from GDP growth, with sluggish export growth and strong import growth. Global economic growth remained subdued, particularly in China, due to ongoing property sector challenges, while Europe and Latin America, dang it, we didn't score. While Europe and Latin America also saw below-trend growth. Financial markets reflected the expectation of rate cuts by the Federal Reserve with lower Treasury yields and slightly higher stock prices. The Fed's financial stability assessment highlighted notable vulnerabilities, particularly in asset valuations and the financial sector leverage. Although household balance sheets remained strong, the financial vulnerabilities were concerning, with pressures in commercial real estate sector and elevated leverage in non-bank financial sector. Looking forward, the staff's economic outlook projected slower growth in the second half of this year with a slight increase in the unemployment rate. Inflation was expected to decline further, reaching around 2% by 2026. Hey, only 2 more years, as demand and supply conditions improved. However, the risks to the inflation forecast remained tilted to the upside, with potential downside risks to the economic activity due to persistent inflation and softening labor market conditions. All right, now on to the participants, those boneheads who are actually in charge. The participants' views on current conditions and the economic outlook. In the recent Federal Reserve meeting, participants discussed the current economic conditions and outlook, noting that while inflation had eased over the past year, it remained somewhat elevated. The progress in disinflation was broad-based across core inflation components, with a notable slowing in housing services prices. Many participants observed that the firm's pricing power was diminished as consumers became more sensitive to price increases, with some businesses even cutting prices to remain competitive. This trend, along with the moderating economic growth in labor costs, was expected to continue, putting downward pressure on inflation in the coming months. Labor market conditions were seen as improving, with a rise in the unemployment rate to 4.1% and a moderation in job gains. Let's see here. Participants noted that the labor market was rebalancing, with less difficulty in hiring and limited wage pressures. Despite these improvements, some participants expressed concerns about the potential risk if labor market conditions continue to ease too quickly. Economic growth was solid but slower than in previous years. The previous year's pace, supported by consumer spending and business investment. However, there were concerns about lower and moderate income households facing increasing financial strains due to higher living costs and depleted savings. Those people at the Fed don't care about the poor. These households were showing signs of stress, such as rising credit card delinquencies and reduced discretionary spending. Participants discussed the implications for monetary policy, with most agreeing that while inflation was moving towards the 2% target, more data was needed before considering a rate cut. They emphasized the importance of data-dependent approach and the need to balance risks of reducing policy restraint too soon or too late. The ongoing reduction of the Federal Reserve's balance sheet and the effects on money markets were also highlighted as important considerations for future policy decisions. All right, and wrapping it up, committee policy actions. In the FOMC meeting, members agreed that the U.S. economy continued to expand at a solid pace, although job gains had moderated and the unemployment rate had increased slightly but remained low. Inflation had increased over the past year, but had eased over the past year, but was still somewhat elevated. The committee noted progress towards the 2% inflation goal, with economic risk becoming more balanced. However, the economic outlook remained uncertain, prompting members to stay vigilant regarding potential risks. To support its dual mandate of maximum employment and stable inflation, the committee decided to maintain its federal funds rate target at 5.25 to 5.5. Members emphasized that they would closely monitor incoming data, particularly inflation trends, before considering any rate cuts. They expressed that a rate reduction would only be appropriate once there was a greater confidence that inflation was moving sustainably towards the 2% target. The committee also confirmed its commitment to reducing the Federal Reserve's balance sheet by continuing to allow maturing treasuries and agency debt, including mortgage-backed securities, to roll off its holdings. Members underscored the importance of the data-dependent approach to future policy decisions and the need to communicate this clearly to the public. Overall, the committee conveyed a cautious outlook, recognizing the need to balance inflation with support for economic growth, while being prepared to adjust policies if necessary to achieve these objectives. Boy, that was a lot. Whole lot of words to say we were just going to hold rates right where we're at, and that the data does not support rate cuts right now, and it might in the future. Might. So, anyways, I know I feel smarter. How about you out there? I know. Yeah. Pretty boring stuff. Alrighty. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. What? That's where you can go get all your financial needs taken care of. Plan for retirement, plan for your kids' college if you're dumb enough to send them there, and a double play. And that's all. I just lost my train of thought. Astros are messing me up today. So, Hope everyone has a fantastical evening, because that's all I had to talk about today. And I'll talk to you all again next time. Adios.